What's going on, everyone? I got a great one for you guys today. We're talking about covered calls. Now, kind of controversial in my opinion. A lot of people love them, a lot of people hate them. Whether you don't like them, whether you like them, they're probably the most basic option strategy out there. There are a ton of pros, there are definitely some cons. I want to talk to you about what they are and also what I'm looking at tomorrow in terms of putting on a covered call in Snapchat. So I'm going to click some buttons, I'm going to see you guys inside the computer. Again, we're talking about covered calls and specifically what makes a good covered call candidate. So again, typing fingers, whatever, I'll see you guys inside the computer. Okay, everyone, we are back inside of the computer, and again, we're talking about covered calls, and in this video, we're specifically talking about what makes a good covered call candidate. So not every single stock out there is going to be a good covered call candidate. Some are going to be great, and some are going to be lousy candidates. So whether a stock is up or down will dictate, obviously, if it's a good covered call candidate or not. So again, in my opinion, covered calls are the most basic form of options trades. So if you're someone who's watching this video and you are not familiar with a lot of options positions or you're not comfortable with them, I think a covered call is going to be right up your alley, at least for your first step into the world of options. So again, we're going to talk about what makes a good covered call candidate. But first, right, what is a covered call? Okay, so a covered call occurs when we sell one call against every 100 shares of stock that we own. So if we only own 100 shares of stock, we can sell one call against that to quote unquote cover our position. Okay? If we own 500 shares of stock, we'll be able to obviously sell 5 calls. If we have 50 shares of stock that we own, we will not be able to sell a call in terms of actually utilizing a cover call. Like in all cases though, when you sell a call, immediately we collect a credit for doing so. The buyer of the option, right? So obviously when we sell an option as a form of a covered call, someone on the other side is buying it. So when we sell it to them, we collect the credit or the price they're paying into our account immediately. Now the agreement of a covered call, okay? The agreement is that if our call expires in the money, so let's kind of take a look at that really quickly. So if our call expires in the money, so we're looking at Snapchat here. We're looking at Snapchat that currently has a price of $10.98. Let's take a look at the $11 strike price here. So again, an in-the-money call means, in this case, the $11 call, which I'm trying to highlight there, the $11 call, which means the $11 call will be in the money at expiration if the price of the stock is above the strike price of the option. So in this case, the $11 call will be in the money 67 days from now if Snapchat is above $11. So that's basically what that part is, okay? So the agreement is that if our call expires in the money, we agree to sell those 100 shares of stock per in the money option at expiration at the strike price. So that's a little bit of a mouthful. So again, if the $11 call is in the money at expiration, which means Snapchat's above 11, we have already agreed to sell it at 11. So if Snapchat 67 days from now goes up to 15, well, we don't get to sell it at 15. We're actually selling it at 11. So that's the deal there. And then obviously, if the price of Snapchat is below 11, 67 days from now, which means the call is out of the money, nothing happens. We don't have to give away the shares that we have. Okay? So, in essence, what we're doing is we're capping our upside, but collecting a credit immediately for doing so. So obviously, again, if we're going to go ahead and sell that $11 call, and if the price of the stock is above that call, we have to sell it at $11, we're basically capping our upside at that $11 strike price. Totally makes sense. All right, so what makes a good covered call candidate? So first of all, we look for stocks that are at the low end of their 1-year range. And the reason for this is because we're interested in playing somewhat of a mean reversion play. A lot of the data that my team looks at on a day-to-day basis is based off of, what happens when a stock is towards its 1-year low. What happens when a stock is towards its 1-year high. And what we've noticed is over a very long period of time, when a stock is near its 1-year low, it tends to go higher from that point. So that's kind of the first thing that we look at to determine what makes a good covered call candidate. The second thing that makes a good covered call candidate is it has sold off greater than 5% in the last 10 trading days. That's pretty much it. So again, I already kind of hinted at this earlier, but Snapchat is a great candidate for something like that. So again, what are the two things that we look at to determine if a stock is an excellent covered call candidate? So again, the first thing that we're going to look at again is if it is at the low end of its 1 year range. Looking at this chart right here, it is about 50 cents higher than its 1 year low, but we could easily say, yes, it is definitely near its 1 year range. And then we're also looking for a sell-off of greater than 5% in a 10-day period. I kind of have this nifty-difty indicator over here that tells me what a stock has done in the last 10 days. As we can see, not only has Amazon sold off 5% over the last 10 trading days, it's actually sold off, what, over 23%. So in my book, this is an excellent covered call candidate. So let's go back and see what we would actually do for that. Now, what I would do, and there's a lot of people that would argue with me, but okay, that's great. What I would do here is, again, if we own 100 shares of stock, we can go ahead and sell one call against that to cover our position. So the way that we can do this on the Thinkorswim platform is to do what we call a covered stock. That's basically another word for covered call. So what we're doing here is we're buying 100 shares at $10.98, and at the same time, we are selling one $11 call for 80 cents. What this does is again, we're paying a debit of $10.98 per share per 100 shares. So we're paying a debit and we're collecting a credit when we sell that call against it. That reduces the cost basis of this trade to $10.18 per share. And obviously we're doing this, 100 times, so it's going to be $1,081 or whatever it is. So that's what it looks like. If we go ahead and see what our maximum upside is, what our maximum downside is, when we go ahead and do that, we can see here that the most we can make is $82. The most we can lose is obviously when the stock goes to zero. However, our break even has been reduced from $10.98 to $10.18. Now, one of the things that a lot of people are going to take issue with that I disagree with is the fact that we are seriously limiting our upside. The most we can make on this is 82. So if Snapchat doubles, it doesn't matter, okay? Because we'll only make $82 per every 100 shares we have, or the example right here, we'll only make 82 bucks, okay? Now, I've been doing this for a very, very, very long time, And the one thing I know about the market is that nothing's for sure. A lot of us have been invested in the market over the last decade or so, and we've very much just seen a one-way market. Very much just a rally from the lows of 2009, depending on when you're watching this video. And most people are used to every stock coming back. It just takes time. But for me, someone who's been active for a longer time than that, nothing is for sure. There is no guarantee whatsoever that any stock is going to come back and go higher than it once was. So for me, this is actually quite interesting. The most we can make is $82. The most we can lose is $1,018. Very interesting on this, though. If the most we can make is 82 and the most we can lose is 1018, it turns out that our maximum upside on this is about 8%. So let's multiply that by 100 because that's what real math looks like to get a percentage. The most we can make on this is 8.05%. Now, when I break it down that way, that starts to get a little bit more interesting because over the next 67 days to make 8% on a single investment, that's a great deal. If anyone else could show me any more of those deals, I'd be very, very interested. Again, 8% over a 67-day period, that's about a 35% ROI for the year. That's a phenomenal return. We haven't seen returns that size in many, many decades over the course of a year. So that's very interesting. Again, 8% upside, that's a really good one for me. I'm very, very happy with something like that. Second, now we've reduced our cost basis. So think about this. on one hand, if we went and bought Snapchat for $10.98 and Snapchat was down a penny from there 67 days from now, well, we would have been a loser on that trade. But if we go ahead and do the covered call on Snapchat, and let's say Snapchat goes down to $10.20, well, our break even is even below that, right? So we would have still been a winner on that trade. So we've reduced our cost basis by 80 cents. So we have a better chance of making money. And I'm totally okay, because again, I've been doing this for a very, very long time. I'm totally okay with capping my upside at 8% over the next 67 days. So that's kind of something to nibble on there. So the covered call, again, we're going to purchase 100 shares for $10.18 rather than $10.98. This alone, okay, in a vacuum, without saying, oh, well, you'll miss out your upside or any of this or that, who has a better chance of making money? The current price of Snapchat is $10.98. That's the current price. Who has a better chance of making money? The person who buys $10.98 or the person who buys it for $10.18? Obviously, that aside, it is the person that buys it for $10.18. Now, again, the issue that everyone else has is that our upside is capped. However, my argument is in 7.29%, I probably plugged in the numbers a little bit wrong, but about 7 to 8% maximum upside over the next 67 days. That's a great deal. That's 1% a week. That's a big deal, or 1% every 10 days. That's a big deal, okay? It's really not so easy to get those type of returns in the market, okay? And again, the cost basis is reduced from $10.98 to $10.18. So we have a better chance of making money versus someone who went out there and purely bought the stock, okay? So again, to me, it's very cut and dry, okay? Again, I'm not someone who's looking to hit a home run every single time. I'm not looking to triple my money or make 5 times my money. I'm not looking to do that. All I'm looking to do is put on a position where I have reduced my cost basis that gives me a better chance of making money on buying the stock. Remember, I told you guys that I never buy stock unless I cover it with a covered call. This is the reason why. While I do limit my upside, obviously the ROI here is pretty good, 7-8% over the next 67 days. And at the same time, I have a better chance of making money because I don't have to buy Snapchat at $10.98. I get to buy it at $10.18. Okay, everyone, let's recap what we just talked about. In order to find a good covered call candidate, we look for 2 things. Number 1, we look for stocks that are near the low end of their 1-year range. So within about 5 or 10% of their 1-year low. The second thing we look at is a steep sell-off in the last 10 trading days. And the way I see that is if a stock is down more than 5% in the last 10 trading days. So we talked about Snapchat. Snapchat is at its 1-year low. Snapchat is down about 25% over the last year or so. So that's a great candidate. And what we decided to do, the price of Snapchat was at $10.98. We decided to sell the $11 strike price for that call. We've maxed our upside at about 7 or 8%. Over the next 67 days. That's what Live does. We've maxed our upside to about 7 or 8% to the upside over the next 67 days. But again, we didn't have to buy Snapchat at $10.98. Because we cover our call, because we cover our stock by selling a call, we get to buy Snapchat for $10.18. So not only do I have the potential, the maximum potential, to make about 7-8% over the next 67 trading days, but I have a better chance of making money than if I just went out there and bought Snapchat by itself. So again, I know a lot of people are going to disagree with that. I've been doing that for a long time. There are no guarantees in the market that any stocks are going to go higher. I think this is a great opportunity. I don't know when you're going to watch this video, but from when I recorded this, the next day, I'm definitely putting on that position. So I hope this works out for you. I hope this cleared up some stuff for you guys. I'll see you in the next video.